The RBI has cut interest rates again, and this one has a direct impact on your savings. On 5th December, the Reserve Bank of India cut the repo rate by 25 basis points to 5.25%. And if you rely on fixed deposits for safe, steady returns, especially if you are a senior citizen, here is the headline. FD rates could start sliding further. So what does this cut really mean for your FDs, your loans and your next money move? Let's break it down. First, the simple link. The repo rate is what the RBI charges banks when it lends them money. When the repo rate falls, bank funding gets cheaper. And when banks can raise money cheaply, they usually don't feel the need to pay you very high interest to attract deposits. So the most common after effect is banks trim deposit rates starting with popular tenures. And this may not come out of nowhere. A lot of banks had already started easing FD rates earlier this year. Since February, several have cut deposit rates by 50 to 100 basis points. Now, with a fresh RBI cut, the odds of more cuts in the next few weeks go up. Experts say the squeeze is usually felt most in the 1 to 2 year FD segment because that's where many banks adjust pricing quickly. So yes, high yield FDs may get harder to find. So what should FD investors do now? Don't panic. Just get smarter with structure. One strategy that really helps in a falling rate phase is FD laddering. Here is how it works. Instead of putting say 5 lakh rupees into one FD, you split it into smaller FDs across different maturity dates. So some mature in 6 months, some in 1 year, some in 2 years and so on. And what does that do? It helps you maintain liquidity when you need cash, avoiding reinvesting everything at lower rates on one bad day, and spread out interest rate risk. And if you are a senior citizen, there is another point. You still get an extra interest bump, usually 25 to 50 basis points over regular rates. So if you spot a good rate right now, some advisors suggest locking a portion into slightly longer tenures, but only if you are sure you won't need that money suddenly. Now, should you look beyond bank FDs? You can, but with eyes open. Some options people consider are high-rated corporate FDs, debt mutual funds, government-backed securities. These can sometimes offer better returns, but they also come with different risks, like credit risk, market risk, or liquidity restrictions. So the rule is simple. Don't chase the highest number. Match the product to your risk appetite and time horizon. And while savers may feel the pinch, borrowers get some relief. Lower repo rates can eventually mean lower lending rates, especially for loans linked to external benchmarks. Now, for example, on a 35 lakh rupees home loan for 20 years, this cut could translate to an EMI drop of roughly 1,850 rupees per month, depending on how quickly your bank passes it on. So cheaper EMIs, better affordability, and potentially stronger demand in the economy. So what's the bottom line? If you are an FD investor, this is your cue to lock in wisely, ladder smartly, and diversify carefully. And if you are a borrower, you may finally see some breathing room on EMIs. For more quick, no-noise explainers on your money, follow Business Standard.